Hello guys and welcome back to another video of Nova Forex. So, in this video we would reveal the best Fibonacci entry setup which is used by central banks and financial institutions in order to make up a profitable trade. But before we start the video, make sure that you subscribe to our channel and hit this bell icon as we upload new and effective smart money trading videos every week. The Fibonacci levels are the areas at which the price gets support or resistance into the market. The Fibonacci levels are the areas at which the market completes its corrective move and continues moving into the existing trend. The Fibonacci numbers which are used by the smart money are 0.382, 0.5, 0.618 and 0.786. Now before we move on to the strategy of the Fibonacci retracement, let us look at some of the basics of the smart money concepts. The market moves into two moves, which are impulse moves and correction moves. Let us learn this with an example. So, in a bullish scenario, the impulse moves are the areas at which the market makes big imbalanced candles which results into a sharp move to the upside in the market. The impulsive move occurs as the traders altogether initiate their buy trades as the market is in an uptrend which results into formation of these big candles. After the impulsive move, the market makes a pullback which we call corrective move. The correction move forms because most of the retail traders think that this is the best time to take profit into the market and thus they sell the shares into the market. After the corrective move to the downside, the price again makes an impulsive move to the upside as the buyers have again taken control into the market. Similarly, in the bearish scenario, most of the traders initiate short position into the market which results into formation of big bearish imbalance candles into the market. After this impulsive move, many of the traders initiate their buy trade thinking that the price has become oversold which leads to this corrective move as the buyers have entered into the market. Now a question might arise in your mind that why should we use the Fibonacci levels in the market for taking entries or exit from the market? The reason behind this is that by using the Fibonacci levels, we can know the areas at which the corrective move would end and an impulsive move would start. Basically, the Fibonacci levels helps us in knowing the areas at which the pullback would end and an impulsive move would begin which would help us in getting up a profitable trade. We can get a nice risk to reward ratio if we enter from these Fibonacci levels points into the market. We plot the levels of the Fibonacci retracement on the chart in order to know the areas at which the pullback ends into the market. The retracement levels which are more respected by the market are 38.2%, 50%, 61.8% and 78.6%. Now let us see how to trade using the retracement levels in the market with an example. Here we have the Euro-Pound chart on 1 hour time frame. We can see that the market is in an uptrend as it formed impulsive move to the upside and then made a pullback or corrective move to the downside. We will focus on the most recent impulsive move in order to look for entries in the market. Now that the price had made an impulsive move to the upside, we would plot the Fibonacci retracement level from the recent swing low to the recent swing high. After drawing the fib levels, we would wait for the price to make a pullback or corrective move to the downside in order to initiate our buy trade into the market. We have taken the 50%, 61.8% and 78.6% levels in this example as these levels gives us a great risk to reward ratio. Now we would wait for the price to reach at these levels in order to take a buy position into the market. Here is our entry point as the price reached at the 61.8% level. We would keep our risk to reward ratio at 3:1. And as you can see that we made a huge profits through this trade. Let us see one more example of Fibonacci retracement in the bearish scenario. Here we have the Euro-USD chart on 1 hour time frame. We can see here that the market is in a downtrend as it is forming impulsive move to the downside and then making a pullback to the upside. We would focus on the most recent impulsive move in order to take entries in the market. We can see market forming an impulsive move to the downside and thus we would draw the Fibonacci retracement level from the wick of this lower high to the bottom wick of this lower low. And now we would wait for the price to make a pullback among one of these levels of Fibonacci retracement in order to initiate our short trade into the market. Here is our entry point as the market reached at the 61.8% level and then formed this big red imbalance candle. We would keep our risk to reward at 3:1. And as you can see that we ended up making up a profitable trade. Remember one thing, that it is not necessary to initiate our trade only when the market makes a pullback and reaches at the 61.8% fib level. In a strong uptrend, the market may retrace to the 38.2% or 50% Fibonacci level and then continue its existing trend. This type of pullback is called small pullback. The small pullback usually occurs when there are aggressive buyers in an uptrend or aggressive sellers in a downtrend. The small pullback indicates that the market is strong. Similarly, the deep pullback is when the market makes a pullback below the 50% fib level. It indicates that the market is weak. Now a question might arise in your mind, that in which of the Fibonacci level should we enter in order to make up a profitable trade? For answering this question, we would learn about the premium and discount zone in the market. Let us learn this with an example. So, here we can see that the market is in an uptrend. We would focus on the recent higher low and higher high to understand these concepts. We would draw the Fibonacci retracement level from this lower high to higher high. The price is said to be in a premium zone when the price is above the 50% fib level. Similarly, the price is said to be in a discount zone when the price is below the 50% fib level. If we enter the market when it is in the premium zone, then we may end up losing our money, as mostly the market makes liquidity zone in order to trap the retail traders. After it, the market comes to the discount zone and then continues its existing trend. We can get a better risk to reward ratio if we enter the market at the discount zones rather than entering in the premium zones. Now let us move to the advanced Fibonacci strategy that you can use in order to make up a profitable trade. The first strategy is to use multi-time frame analysis along with the Fibonacci. The multi-time frame analysis basically means the analysis of two or more than two time frames in the market. Our aim with this strategy is to enter the market when it creates a pullback. Let us learn this strategy with an example. So, here we have the Euro-New Zealand dollar chart on 15-minute time frame. We can see that the market is making higher highs and higher lows, which indicates that the market is in an uptrend. We can see that the market made an impulsive move to the upside, and thus we would draw the Fibonacci retracement level from this higher low that formed before the impulsive move to the wick of this higher high. Now that we have drawn the Fibonacci retracement levels on our chart, let us wait for the price to make pullback at one of these fib levels. The market reached at the 0.618 level, and thus we would switch over to the higher time frame, which is 1 hour time frame, in order to see if the market is in a clear uptrend or not. We can see that the market is in an uptrend in 1 hour time frame chart also, as it is making higher highs and higher lows. And thus, we would initiate our buy trade on the 15-minute chart. We would place our risk to reward ratio at 3:1. And as you can see that we ended up making up a profitable trade. Now let us see one more example of this strategy in order to make sure that you understood it properly. Here we have the Euro-Pound chart on 15-minute time frame. We can see that the market is in a downtrend as it is making lower highs and lower lows. We would focus on the recent impulsive move in order to initiate our short trade into the market. We would draw the Fibonacci retracement from this lower high that formed before the impulsive move to the bottom wick of the lower low. Now we would wait for the price to make a pullback at one of these levels in order to initiate our short trade into the market. We can see that the market made a pullback at the 0.618 Fibonacci level, and thus we would switch over to higher time frame, which is 1 hour time frame, in order to see if the market is in a clear downtrend or not. We can see that the market is forming lower highs and lower lows, which indicates that the market is in a downtrend on higher time frame also, which is why we can say that the market is in a clear downtrend. And thus, we would initiate a short trade from this 0.618 Fibonacci level on the 15-minute time frame. We would keep our risk to reward ratio at 3:1. And as you can see that we ended up making up a profitable trade. Now that we have learned the first strategy, let us move to the second strategy. So, in this strategy we would use the flip zones along with the Fibonacci retracement in order to take entries in the market. But before we dive into the strategy, let us learn some of the basics about the flip zones. The order blocks are not always respected by the market. Sometimes the market makes big imbalanced candles at the order block zone of the opposite direction and then continues its trend. Basically, the flip zones are the areas at which the market switches its role from support to resistance or vice versa. Let us learn this strategy with an example. So, here we have the euro-yen on 1-hour time frame. We can see that the market formed a flip zone here. And thus, there is a higher probability of price going upwards after returning back to this zone. And thus, we would draw the Fibonacci retracement from this candle which formed before impulsive move to the wick of this higher high candle. Now we would wait for the price to retrace to the 0.236 fib level in order to initiate our buy trade into the market. Here is our entry point as the price reached to the 0.236 fib level. We would keep our risk to reward ratio at 3:1. And as you can see that we ended up making up a profitable trade. This brings us to the end of this video. But before we end this video, make sure that you subscribe to our channel and hit this bell icon as we upload new and effective smart money trading videos every week.